The daily edition of Market Wrap with Mo Ansari.
Brought to you by Compact Asset Management.
Providing proactive portfolio management and world-class wealth management solutions.
Hello, everyone, and welcome to Market Wrap. I'm Mo Ansari, president of Compact Asset Management, and you're tuned in as you've been doing so for 2 decades now. And as always, you can call in, and I will be more than happy to share with you my 33 years of trading experience. On our guest line is Mr. Alan Murray. He is the deputy managing editor and executive director online for the Wall Street Journal. Mr. Murray joined the Wall Street Journal in 1983 as a reporter covering economic policy. He was named Washington Bureau Chief in 1993. During his tenure, the Washington Bureau won 3 Pulitzer Prizes, as well as many other awards. Mr. Murray is currently responsible for the Journal's website, including the WallStreetJournal.com and MarketWatch, and the Journal's books, conferences, and television operations. Previously, he served on CNBC's TV's Washington, D.C. Bureau Chief and was co-host of Capital Report with Alan Murray and Gloria Borger. Alan also holds a master's degree in economics. Mr. Murray, welcome to Market Wrap.
Good to be with you, Mo.
Alan, let's take a look. What caught my eye was your recent article, the 2011 Economic Outlook, and what it means to you. You suggest that the recent gifts from Washington, which refer to the recent tax package, may not lift the cloud of uncertainty hanging over the economy. Why do you think that?
Well, first of all, I think what they will do is spark some economic growth in 2011. I think the combination of the Federal Reserve and Congress doing everything within their power to get the economy going again will pay off, and you'll see some movement in the coming year. But what I argued in the piece was that really doesn't end the uncertainty, principally because the government is both printing money and piling up massive debts in order to pull this off.
Well, Mr. Murray, if you're the administration right now, you're sitting in Washington, you saw what happened in November, you have to bring unemployment down, otherwise you don't have a job. I'm talking about politicians, especially the Democrats, knowing they don't have a job in 2012 if they do not bring unemployment down. They get it now that it's all about unemployment.
Right. But if you talk to economists about this, the right thing to have done when Congress was around a couple of weeks ago would have been, one, yeah, sure, put some more stimulus in the economy to help make sure it's growing in 2011, but two, take some action to show that you're willing to deal with this enormous deficit problem.
Now, politicians, what makes you think that they're going to come around in 2011 and say, you know what, we have found it. We have seen it, and we get it now. We're going to bring the deficit down. We're going to fix Social Security. We're going to make the hard decisions on Medicaid and Medicare, which is even a bigger problem than Social Security. And we are going to do these hard things. And we're not going to get elected. But again, we've got to remember, we are the ones who elected these people. So as I say, look, everybody wants the deficit to be cut. But everybody says, look, yeah, cut the deficit, but do not cut any of my benefits. I want all of the stuff that you're giving me, but cut this other guy's stuff out there. I want all of the stuff that I want. So
I always think of it as being a little bit like that country music song. Everybody wants to go to heaven, but nobody wants to go now. I think the deficit is the same sort of thing. Everybody wants to cut the deficit, but nobody wants to take any of the painful steps necessary to get there. You're absolutely right. I mean, the kind of, quote, bipartisanship that we saw in November and December was of the Santa Claus variety. The Republicans got to be the Santa Claus of tax cuts. The Democrats got to be the Santa Claus of spending, and everybody's happy. You could have an economic crisis that forces action.
Right.
I mean, let's say that by the end of next year, you start to see the economy really picking up speed. Private companies are borrowing again. The government is still borrowing like gangbusters.
We're at 10-year highs. Yes, interest rates have gone up, but they're not at a painful stage where they start really to retard growth or start hurting housing again. Why is the stock market so happy?
Well, I think the stock market right now is looking at the first part of what I said, that we are seeing signs that that the economy is recovering, that there is growth. But I wouldn't expect uninterrupted market happiness over the course of the next year because this huge cloud does hang over the economy.
So you think this $1.5 trillion, the $600 billion that the Fed is putting in, $850 billion that the stimulus plan and all of that is what is giving this market a sugar high, a temporary boost?
That's a good way of putting it, because we know it all. At some point, it all has to come out,
right?
And you can imagine maybe the exit process, the turning off the taps at the Federal Reserve.
Let's talk a little bit about your article. Also includes a section called Your Financial Plan. Let's look forward. People are driving along right now up and down the West Coast in a lot of rain, but that's where they are right now. Which details, the article details some ways to prepare for this new and uncertain economic environment, quote unquote.
Well, okay, let's start with interest rates.
Right.
Interest rates are very low right now. It's almost a sure thing that a year from now they'll be higher. Mm-hmm. Significantly higher. You can already see that move happening.
Right.
And so anything you can do to reduce your exposure to rising interest rates, lock in, make sure you have a fixed rate on your mortgage, get rid of your credit card debt, anything you can do that reduces your exposure to interest rates, you should do. That's step one. Step two is taxes. I mean, we have been granted a reprieve on the tax front, but it is a temporary reprieve. Mm-hmm. Okay, so the taxes aren't going up, income taxes aren't going up this year or next year, but you can bet that particularly for upper income people, they will go, and probably for a lot of middle class people, they will go up come 2013 because there's simply no way to get the deficit numbers to work without taking some action on the tax front. Doesn't have to all be on the tax front, but you really can't do it on the spending side alone.
So what does the average investor do to mitigate that tax bump that is coming?
Well, you think about whether there are opportunities to move income into 2011 and 2012 when taxes will be lower. Roth IRAs are one thing that some people are thinking about. Should I go ahead and pay taxes on my retirement earnings now in order to be able to have them tax-free when I actually retire? That's what the Roth IRA conversion does. Right. There are a number of issues like that you can do to take advantage of lower tax rates now when you know they're not going to be permanent.
So one, you've got to worry about interest rates going up. If you're holding, fix your mortgage. If you have a adjustable rate. If you're holding bond funds and short-term treasuries or high-quality bonds, those will also, or muni bonds, which have gone down a lot in the last few months, those people need to be careful about, right?
They'll go down more, yeah. I think now's a good time to be getting out of those bond funds.
Okay. What would be the third thing that you would look at as some of the things that you've talked about in your article?
Well, if you look at what's going on in the market, it's clear that a lot of people are worried about inflation. Okay. I don't think that's a real risk in 2011. I do think there's a possibility that the prospect of inflation causes the Fed to raise interest rates.
Right.
But I don't think you're actually going to see substantially more inflation anytime in the next year or so. So all these people who are rushing into gold, I'm not sure I would follow them.
Because we're not really getting inflation, the kind of inflation that we get when prices go up. But commodity inflation, do you think that might be something that people might want to consider because of demand coming in for grains from China and India? Because the first thing people buy before they go out and buy new jeans and Nikes or whatever is they want to get a better diet. Do you think that might be something that we might see commodity inflation, but not real inflation?
Yeah, I think you could. Well, you've already seen that, right?
Right.
And I think if you can continue to see strong growth in the developing world, then that could continue. And that leads to another recommendation for personal finance and for investments.
Right.
We are most likely entering a period where the developing world is going to be growing at a faster clip than the developed world because of this huge debt overhang that we have in the United States and that many European nations have as well. So it's a good time to make sure that your investment portfolio is diversified and that you have some investments that will take advantage of the faster growth in Asian countries in particular. I wouldn't overdo it. I wouldn't assume that China will grow forever, but it certainly looks like for the next few years you're going to get better growth in those countries than you will in the U.S. or Europe.
Mr. Murray, I want to thank you for taking the time out of your busy schedule, being with us today, sharing your article, and giving us some clarifications and some ideas of what people can do for their portfolios to take advantage of this sort of topsy-turvy world that we are in right now and the things that we are going through. Thank you so much again, and have a wonderful new year.
Thank you, Mo. Same to you.
That's Alan Murray. He's the Deputy Managing Editor and Executive Director online of the Wall Street Journal.